Okay, everyone, welcome back. This is day 2 of the AR and revenue cycle class activities video. Um, and so, just a reminder, we're working our way down the balance sheet. We're on AR and its associated income statement account of revenue. And so, as we continue moving, just a little reminder about how the chapters are set up. I'm not going to go over that again today since I went over it the last class. And also a reminder how we're using the audit risk model basically to drive how we decide what kind of tests we're going to do ultimately based on the audit risk we set initially, the understanding the client and the environment to set our inherent risk, understanding the control risk. And again, we're going to do this at design. We're going to look at the design first, and we're going to come back later and look at the operating effectiveness with our testing. And we've talked about how that decision to test is an important one and impacts ultimately our detection risk. And remember there, we're focused on allowable detection risk. What can we get away with, basically, based on all the other factors, how precise, how tight, how careful do we need to be in our testing, right? And so we largely spent the last class talking about control testing, and so today we're going to spend some time on some substantive testing. Now, again, I've said this a couple times, but every time you see some of these figures, you want to try and spend some time on these, right? These are good because we want to be able to make this connection between what we're doing and why are we doing it. Like, what audit objective are we getting comfort over? And again, those audit objectives are just assertions that are related to specific accounts. And so, for example, if we looked at this first one, obtain an aged listing of receivables, you actually did that with the SUA, or you're going to do that with the SUA, and you're actually going to be the one to prepare it in the SUA, but the auditor would receive that listing from you and then take it back to the subsidiary ledger. So, for example, the AR subsidiary ledger, and then they're going to confirm all the accounts that have a balance, making sure they made it onto that listing, and then making sure that they aged the listing appropriately. And why do you do that? Well, you do that because you're trying to get at, well, how much allowance should I have accumulated, or how much bad debt expense should I, and ultimately how much bad debt expense do I need, right? And so that allowance, that's where the valuation piece comes in. And also we can check to make sure that not just the AR subsidiary ledger connects to that listing, but also that also matches up with the general ledger. That's supposed to be a G/L for general ledger, okay? There's accuracy there, so those things should line up, okay? We're going to talk today about confirmations, so I'll spend more time on that in just a minute. But obviously, if we're going to look outside of the firm, that's what a confirmation is. It's looking for some evidence outside the firm from another party. Well, that helps with the validity, right? Does that receivable actually exist? / did the transactions occur? Those two are really closely combined, so it's hard to kind of disentangle those a little bit. Do we have actually rights to it, or the debtor is going to challenge those rights? Valuation also gets to basically that gross number sitting on the balance sheet, and then accuracy, if there's any issues with certain transactions that need to be corrected. Right, that would also help by getting evidence from outside parties. All right. So if we look at our well, we had actually done this where we looked at internal control strings already. But if we look at this confirmation process, then this is an example of an overall figure. So let's say, right, this is in the subsidiary ledger, right? We've got ABC Company as a client, or at least, excuse me, our client has them as a customer, and it says they owe them $220,000. Obviously, this is a business-to-business set of transactions. And so the general process is we're going to have a request that's prepared. A confirmation request is prepared. CPA is going to make sure that it's to the right individuals. Now, we'll talk about, there's other ways to do this. We want to mail it. Now, there's things like confirmations.com is an example, right? And they're basically trying to make this process faster. Instead of back in the day, back in the dinosaur period, pre-Jurassic Park, we'd have to mail confirmations out to the individual customers, right? But now they're trying to speed that process up, and so if it's a business, then you have a better chance of getting on something like confirmations.com. But the general process is the same, right? The auditor wants to be in control of getting that confirmation to the customer, right? And the customer gets it. Hopefully they respond, but not all confirmations are going to be returned, right? And so we're going to have some what's called non-respondent bias here, and we're going to think about, okay, for those that didn't respond, are they more likely to have a problem or more likely to not have a problem with the amount, right? And so we have to think about that a little bit. Usually it's everything looked fine and they're not going to challenge it, but we can't always assume that. Now, it's important to know that the response comes to the auditors. We don't want the client to get a hold of these confirmations and potentially change them. And so if we're going to get external evidence, we want that the client to be as minimally involved as possible, right? And so that's the general process there. We're going to take a look at an example situation where we're basically going to audit this company called Wellington's. This is our client. And so we're the CPA. And so the CPA obtained and documented an understanding of the client's business and environment, right? So we got inherent risk, including internal control and the control risk. Assess that risk and material misstatement, which is just the interaction of those two, and focused on these assertions, existence, rights, and valuation, and said that risk is actually high. Okay, so the CPA requested and obtained an aged accounts receivable schedule. Again, that's what you all did or will do in the SUA. And it talked about basically lists each customer balance as at the end of the year. And then they sent positive confirmation requests, right? Positive just means please respond, period, right? Doesn't matter what's going on. Negative confirmations basically say respond only if an issue, right? And these are going to provide less assurance because, right, you're basically saying, yeah, don't respond if it's fine. But the problem is you're also going to have some responders in here, or excuse me, some non-responders with an issue, and they're just too lazy to respond, or maybe the thing got lost in the mail, or maybe the person who was supposed to do it didn't get a chance to do it. Whatever the reason is, we have some non-responders in here, and they can be different, right, in terms of the conclusions we want to draw about their non-response. How about we just say can differ? Okay, so we have the positive one, which basically says please respond. Okay, so the CPA asked the staff assistant to follow up on in this case they had 9 returned, oh that's a bad line, sorry about that. They had 9, that's not a much better circle, is it? And they have 9 returned confirmations that follow And so we're going to assume it's material if we project it to the population, and we're also assuming that the debit balance is the result of a credit to sales. Right, so the AR balance this is basically all credit sales, right? Is what it's trying to say. That's what the activity is. And there's some additional information. And so our job is going to be to describe the procedures that the CPA is, junior person should perform to resolve each of the confirmations, and possibly, if possible, talk about an updated value of that subsidiary ledger account. Right? So should we change that in any way? Okay. So again, my encouragement to you: go ahead and pause right now. Spend maybe 15 minutes working through each of these, and again, the problem's available on the website. The solution's there too, but again, I think it's good if you can struggle with it a little bit before you jump to a solution. Okay, just my encouragement. Okay, so here's the handout. So if you look at the first one, this is the response that our client, that our client's customer has sent back to us as the auditor. Okay, so they're saying the statement of our account showing a balance of $20,000 due is correct, except as noted. What happened to my? Let's get a different color here. 1 second. Okay, now we're ready to roll. So they're saying, hey, everything looks good, except, okay, here's where it goes. So we ordered it, but we mailed them a check, right, on 12/18. Okay, so then Blocker, I believe, is the controller or something, indicates that the check was received and deposited on 12/28, but just was posted to the wrong customer's account. So what do we need to do to follow up on this? Well, one, let's determine the check was received. How can we do that? Well, we can look at the cash receipts journal, right? Maybe a cash pre-list, if you remember that from yesterday days. And we want to confirm also that it was deposited. And so that's when we can look at maybe a bank deposit slip. Or even a bank statement. Now it depends on how much they're bundling checks together and that kind of thing, whether you can tell. But if you have a cash receipts journal and a cash receipts pre-list, you kind of know what is deposited together. And then if you can see that deposit actually being made in the bank, then you feel comfortable, right? And then what else do you need to do? You want to confirm the error was corrected in the subsidiary ledger. For that account. And then you kind of need to figure out if this is part of a broader issue, right? Is there an individual who's kind of struggling to do good work in the area in terms of whoever's in charge of the subsidiary ledger? Is there some controls that should have caught this but maybe didn't? So those are kind of things that you would want to think about when you're trying to evaluate this, right? If there's supposed to be controls that should prevent this, then why didn't they work, for example? And then obviously the balance should be 0 for this account, assuming all that is corrected or is confirmed. Okay, so assuming yes, we did see it in the cash receipt journal, and then we saw it in the cash pre-list, and we saw the bank deposit slip to match the pre-list, and we saw the bank statement showing yes it was there. If we assume all that stuff, then this balance should be 0. Okay, so if that makes sense, and again, if you need to stop now, because maybe it makes a little more sense to you how to process this, then go ahead and stop now and work on the other 8, right? And then just click on play when you're ready to come back. Okay, So another confirmation. There's a balance of 12,222. Here's their response. The client's customer says, "No way, forget it. They said we'd have it in 10 days. Didn't receive it. Canceled the order. Then we got some goods from another company. We'll never use them again." Okay. So, one, let's determine if the goods were shipped. Because that should be what kicked off the recognition in revenue and the recognition therefore in the accounts receivable, right? If they were never shipped, that's even a bigger problem, that they're recording transactions without actually shipping. And again, as the auditor, these are things that I need to do to follow up on the confirmation responses we're getting back. So if so, were they returned? So maybe they returned them at some point. So for example, if they did ship them, then okay, they do get to recognize revenue, at least initially, and then look to see were they returned, right? It doesn't mention anything like that in the response, but it's possible they returned them. And then the other thing we're going to follow up on is return policy. Of the contract, right? So when I say contract, it could just be something as simple as a purchase order. So, so when I confirm details and determine if valid claim by their customer, right? So what I mean by that is, let's say, even though they might have promised the goods in 10 days verbally, the contract or the purchase order doesn't say anything about that. Doesn't say anything about how delivery or how the transaction is conditional on delivery being made within 10 days. If that's the case, then okay, then they probably do still have a claim, assuming they ship the goods. And so we have several things that are working here, right? And so we have several conditions that we need to figure out. But let's assume that our client's customer is correct, and so the balance most likely, or at least more likely than not, should be 0, right? And again, the balance of the subsidiary ledger account for this Wilson Delco company. Okay. Next confirmation, and usually we only do about 3 or 4 of these in class, so I'll probably get through about the 4th one, and then hopefully that will be enough to go along for you to look at the solutions and then get a sense of it. So the next confirmation from another client, so they're saying there's $22,000 were on the account. Again, they're saying, here's the exceptions. They're saying we use a voucher system. That's by individual invoice. We can't verify the balance, but Wellington's probably one of our regular suppliers, so we owe them something. It's not really great record keeping there. And so what can we do? Well, what are they saying? They're basically saying, yeah, we don't really summarize by our vendors, because that's what our client is, basically a vendor to them. And so they're basically saying we don't do that, we just pay by individual invoice. Okay, so what can we do? We can obtain the listing of unpaid invoices for this customer, right? And then resend the confirmation with that detail. asking them to confirm, right? And so if their information system isn't set up to handle summarization by vendor, which seems pretty silly, but it's possible, I suppose, then we would just provide the information they can confirm. Now, obviously, depending on how long these things take, we can also examine invoices and shipping documents to get some additional evidence in the meantime. It kind of depends on how late we are in the process. All right, confirmation 51. We got the $75,000 balance to our client's customer, Farkil, I don't know how you say that. They say, oh, our records show that we sent them a check on 12/29. Okay. So in their in this Farkil Corporation, in their mind, right, that's good enough to wipe out the balance. But in our client's perspective, they have not received any check yet, so you're not going to anticipate a check being paid. Okay. And so what can we do for this one? So determine if check was received. Again, you can do something like the cash receipts pre-list / cash receipts journal. And it's possible, if it's after year end, it's possible that, again, their records show that there's no balance as of 12/31, but there's a transit period there. And so if after year end a check is received, then no adjustments are needed, right? Because it can't be simultaneously true that the client shows a balance of 0, but then our client has a balance of 75,000, and the difference is the timing, right? They can record that as soon as they send the check, but our client cannot record a receipt until it is received, and therefore they might have a balance at year end, but then obviously it would clear up shortly after year end, assuming that check was received. Okay, does it make sense? Hopefully, I'm asking a question, no one can respond. So I would work through those. Again, there's a few more on the back here. And again, what are we trying to do? We're trying to think through the process of how to evaluate these confirmations, right? What do we do with them? Because not every confirmation is going to say, yes, I completely agree with the balance, right? Because of the different recognition rules, then you're going to have trade-offs rather, in terms of showing a balance on one customer account but not on the other. Okay, so work through the rest of these. The solutions are posted. Please let me know if you have questions. But otherwise, this is a good example of a substantive test, because we can actually get to, okay, what should the balance be, right? We talked in a couple of different places. Oh, balance should be 75,000 there, or 0, depending on what's there. And so this is getting us closer to getting to the dollar amount that is on a financial statement, or at least the amounts that are going to summarize into the financial statement. All right, okay, that'll be it for this one.